Thank you very much, that voice from above, for this introduction. It's great to be here with all of you, and a big thanks to the Monetary Authority of Singapore, the Association of Banks in Singapore, and SingEx for putting together this absolutely terrific event. It is truly one of the best forums to meet, discuss, and debate the future of finance. And in Singapore is particularly the right place to talk about investing in the future of finance. That's the topic I'm going to spend a few minutes on, and then we'll have a panel that'll join me, and we'll talk a little bit about the future of banking. But before I talk about the future of finance, let me talk a little bit about the past and why this environment is a little bit different. Financial services has always been a fertile ground for disruption and disintermediation. In fact, the very existence of capital markets is a testament to people like you who at one point thought there was a better way to distribute capital where it needed to go and to do it faster and more effectively. When I joined the industry many years ago, we were actually initiating a lot of change from inside the industry. As an example, in the mid-90s, the equity trading market went through a massive shift. What had been a manual market-making process became completely automated. This was where machine learning and artificial intelligence originated in finance, and it was an exciting time. We saw this desire to innovate across the spectrum of all financial services offerings, from institutional to corporate to consumer products and services. But back then, the industry had a lot of tailwinds. It had capital, it had talent, it had the scale to transform on its own, and it did that. It created new consortiums, utilities, consolidated the laggards, and while there were new competitors, the pace of innovation was largely set by the incumbents. As that was going on, there was also disruption happening all around us. My bank in the mid-90s led the Netscape IPO, and the internet was open to the masses. Online retailing, new media companies emerged. Some of the incumbents in those industries were either held captive by their old models or misread consumer behavior. The results of their disruption are now evident. And then in 2007, it took a large computer company to change the future of mobile telephony. Amongst Apple's peers, you saw different responses to changes in technology. Nokia responded very differently. Samsung did it very differently as well. All of this is to say that industries evolve in many ways. Sometimes disruption is driven by the industry itself, sometimes by consumers, sometimes by invaders from other industries, and sometimes by new market entrants. But what makes this current environment very different is that disruption seems to be driven by all of these factors at once. There is an intense battle going on for customers, whether core or latent or underserved. And the pace of change is happening a lot faster outside than inside incumbents. I think it's important to understand why. First, it's easier to set up a new business today than it has been in the past. Technology has brought the marginal cost of starting a business way down. That means it's cheaper, faster, and easier to establish a low-end or a new market foothold, which has been the standard way to disrupt industries in the past. Second, the same process of disruption that affected manufacturing is now making its way into the services sector. Thanks to abundance of data, artificial intelligence, machine learning, other technologies, the services sectors can now be automated. And third, and very important, for especially people in this room, we are in a prolonged and unprecedented cycle of cheap capital. We've seen billions of dollars flow into early stage companies over the last few years. There's more appetite for risk and more willingness to fail. But the most important impact of cheap capital is on business models. Every company has a production function that combines capital, labor, and technology to create products. Today, there is a fundamentally different way to combine cheap capital and cheap technology to create a better product in a more efficient way. So capital and technology can now be put together in fast, frugal, and efficient ways in more industry sectors than before. And new market entrants don't have to go just after the low end or underserved markets. They can compete directly with incumbents by using a different combination of production inputs to create more efficient business models that aim to capture customers with a better proposition. We've seen this happen in many industries, from retail to travel to hospitality. Customers have come to accept they don't need to go to a bookstore to buy a book. Old institutional structures have been appended by new architectures that empower customers to do the jobs that need to be done in cheaper, faster, and more convenient ways. Financial services, on the other hand, is at the nascent stage of this evolution, and frankly, the industry has yet to see the full potential of technology on bringing costs down and improving customer experience. For example, in retail banking, more than 80% of transactions are still done in cash. People still use checkbooks. Even mobile payments can take days to clear. And that's just one segment of the industry. There are many such examples on the institutional side as well. This means the industry is fertile ground for innovation. It remains true that many customers still think about banks in their traditional institutional form as the place they have to go to in order to do banking. Over time, we think this attitude will be tested as financial institutions get unbundled, financial functions get rebundled around actual customer needs. The industry will likely evolve from one dominated by large conglomerate banks to a broader, more decentralized network of financial services companies that offers finance bundled with commerce or content. And there will be a tremendous amount of opportunity to invest in this shift across the spectrum, but it's still very early days, and any prudent investor should anticipate stresses and cycles that test business models. So what will this evolution entail? If you think about it, banks are basically in the business of storing cash, moving money around, making loans, saving and investing. But banks generally are organized by product. They're focused on what they can sell to customers rather than what they can do for customers. Entrepreneurs around the world, meanwhile, are just beginning to redefine financial services and what it means to put clients' needs first. For example, instead of focusing on products, they're focusing on functions. What are the jobs that clients and customers want done, and what are the best ways to get those jobs done? But financial services is not like any other industry, though it is integral to every other industry. You could argue that because the payment is required with every transaction, financial services really represents half of economic activity. Therefore, the vital role of financial services is evident, and it requires guardrails to ensure there is safety and soundness in the system. These guardrails begin with investors and entrepreneurs holding this goal paramount to all others. But it also translates into the following. Financial services lives or dies by regulation and its regulators. While there are plenty of opportunities for investors to participate in the re-architecting the industry, there is no investment team in financial services that can ignore that premise. And that's why it's good to be in Singapore, because this is where it is understood that a regulatory architecture rooted in the mission to ensure that the system is sound, the customer is protected, and the economy is stable can also provide fertile ground for innovation. In many places around the world, the regulatory architecture still focuses on products, not functions. But in Singapore, regulators understand the industry is evolving, and that is why they're creating sandboxes to provide safe environment for companies to test their products. As we all know, financial services is not a winner-take-all industry. There's plenty of room for incumbent institutions and banks and new entrants to compete. And competition is good. It can lower costs and can increase access. Competition with the right regulatory architecture in place can facilitate a race to the top in terms of best practices rather than a race to the bottom. So investing in the future of finance is about more than entrepreneurs investing and putting their sweat and equity capital to work. It's about fostering the right environment so that market participants compete to provide the best services and products. and compete to be the best providers of those services. It is about investing in the right architecture and building the strongest foundation for this competition. And regulators play a key role in encouraging innovation in financial services. That is what is happening in Singapore, and that's why we're here today. I look forward to discussing this more with you, with the rest of my colleagues on the panel. Thank you.